Digital assets and cryptocurrency, and a topic that I think many of our listeners are probably curious about. Broad range, I would assume, of understanding on these topics, on the terminology, but lots of questions. What exactly are digital assets? Why have they come to be? Where might they or might they not fit in the portfolio? What are some of the tax considerations? I think there's a lot of things swirling, and certainly there are the digital asset nerds out there. But we're going to go through more of a 101 covering those different aspects that I just mentioned surrounding digital assets. And Tim, I think right now more than ever, just given the rise in Bitcoin in particular, but digital assets as a whole, since the election, this is getting a lot of attention right now.
Yeah, it sure is. And you saw you saw Bitcoin and digital assets really take out off since the election. I think there was definitely different views on where digital assets fit in our future, depending on the candidate. And we're seeing that a lot of people in the digital space liked the like a Trump presidency a little bit better than a Harris presidency. So I think some of the reaction in the market is to the election, and a lot of people that are in positions of power in our financial system that might have blocked or not been as bullish on crypto or digital are going to be replaced or stepping down. I think there was
Mm-hmm.
news that as of this recording, I think it's bumping up against $100,000 Bitcoin is, with news that people are going to be stepping down and kind of paving a way for what this looks like. So I'll preface this with saying I am not like a Bitcoin bro, Tim, but I am a believer in digital assets. A couple of
Mm-hmm.
years ago, I kind of got tired of parroting some really smart people on Wall Street that said, hey, it's a fad or
Yeah.
it's not mature enough. So I took I got a certificate in blockchain and digital assets that was offered by the Digital Assets Council of Financial Professionals,
Mm-hmm.
which is actually set up and run by a guy named Rick Edelman, who basically built the largest RIA in the country. So a very traditional sense of investing. And it opened my eyes to this world and what the potential is. Obviously, there's a risk associated with digital assets with any new asset class. But I think what I wanted to do is kind of learn and not have my mind made up by someone else, right? And
Yeah.
and not the not you kind of do my own research type of
Yeah.
thing, and I think that's important. So there's a lot of people that are going to be listening to this be like, no thanks, this is not for me, and that's okay. I don't think it's meant to browbeat anybody into this into this type of investment, but I think it's important. So when we talk about digital assets, Tim, we're really talking about, and I use digital assets, I don't use cryptocurrency because not every form of digital assets comes from cryptography.
Right.
So I use the broadest form. So digital assets are really any item of value that exists in digital form, and can be owned, controlled, or exchanged. So you could say that like my iTunes library is a digital asset. We're going to talk about it a little bit differently, but it may or may not be stored, on a blockchain. The
Mm-hmm.
characteristics of digital assets are typically they're intangible. So unlike physical assets, digital assets exist only in digital form, or electronic form. We'll say the ownership can be owned, transferred, or traded. They're often secured by cryptography, and that's a method of security. There's value, so there's economic or utility value associated with this, and that can be intrinsic or based on what the market says that there's value.
Mm-hmm.
And that's where a lot of traditionalists said like there's no intrinsic value, and we'll kind of talk about that here in this episode. And then the storage, how is it stored, typically on servers, databases, or decentralized networks like blockchain. So that's kind of to set up the topic du jour today, Tim.
Yeah, I appreciate that, right? Because I think we get narrow on this topic sometimes of,
Yeah.
Bitcoin, right? And we're talking more broadly about digital assets. We'll talk about cryptocurrency in particular. I'm sure Bitcoin will come up in discussion, or the spot ETFs that were introduced earlier this year and the significance of those, and the SEC, really approving the use of those and perhaps making this come more mainstream. But it is worth noting, renoting what you said, which is, hey, this may not be for everyone, and that's okay, right? Just like other investments we talk about, just like real estate that we talk about on the show, like some people it makes sense. It makes sense for a larger percentage of their portfolio or smaller percentage of portfolio, but we have to go back to, what does your individual situation look like? What is your risk tolerance? What is your risk capacity? What are we trying to accomplish? What are we trying to achieve? And as Warren Buffett, once famously said, never invest in a business you cannot understand, right? Same applies here, that if we're going to make a decision to make this a part of our portfolio, and we'll talk more about when that may make sense, what that could look like, knowing everyone's situation is different, we want to feel good about understanding this. I don't think it ever feels good to invest in something where you're like, I'm a little bit risk averse on this and I don't really understand it, right?
Yeah. But
Um,
I would play the devil's advocate there. I think there's a lot of people that invest in more mutual funds in their 401k that don't fully
True.
understand how mutual funds work,
Yeah.
right? So again, I think that's where partly like an advisor or somebody that you trust can be, kind of a guide in this. But I do think that something like this, especially with it being new, I think doing some research and understanding what that looks like is important.
So talk to us about the role of the financial crisis of 2008, really being the fuel that led to the rise of digital assets.
Yeah. So if we look at like the genesis of digital assets, it kind of started with a white paper um, entitled "Bitcoin: A Peer-to-Peer Electronic Cash System" that was published in October of 2008. But the lead up to this really kind of started. It started before 2008, but it gained a lot of traction in 2008. So if we go
Mhm.
back to March of 2008, Tim, this is where Bear Stearns collapses. So Bear Stearns is a major investment bank. It faced a liquidity crisis due to its exposure to the subprime mortgage-backed securities that it had invested in. So investors lost confidence and the firm couldn't meet its obligations. So the Federal Reserve facilitated a buyout. I think it was like 30 billion in guarantees from the Fed for Bear Stearns kind of they called these toxic assets.
Mhm.
So this was kind of the canary in the coal mine, so to speak, with us looking at the like a major financial institution and saying like, hey, is there vulnerabilities here? If we fast forward to September of 2008, early September, we started to see problems with Lehman Brothers. They were also heavily invested in the subprime mortgage backed securities, and they declared bankruptcy on September 15th. And they tried to get buyouts from Barclays and Bank of America. If you've ever seen or read the book Too Big to Fail, it kind of goes
Mhm.
through this. But this bankruptcy was a $600 billion bankruptcy, was the largest in US history. And this kind of triggered, a cascade of panic in the market. This is where you started to see credit freeze and just deepening distrust. Um, September 6th, this is when the government takes over Fannie Mae and Freddie Mac.
Mhm.
So these are what's called government sponsored enterprises, GSEs. And that they guaranteed over $12 trillion in US mortgages. So if you remember this, it's like if you could fog a mirror, you could get a loan, right? And
Mhm.
and there was just so much risk in the market, and it caught up. So um, they placed the Freddie Mae and Fannie Mac into a conservatorship, and the Treasury injected like something like $200 billion.
Mhm.
And this was crucial to kind of have stability. But then shortly thereafter, Bank of America buys Merrill Lynch. This is on September 15th of 2008. They agreed to buy Merrill Lynch because Merrill Lynch was in trouble because of the subprime mortgage. The federal primary, this was a big deal. This is where people started to take money out. Like on
Yeah.
September 16th, they called this. This is when the Reserve Primary Market Fund broke the buck. So the Reserve Primary Fund is a major money market mutual fund, and it announced for the first time that the net asset value had fallen below $1 per share or broke the
Mhm.
buck. So this was supposed to be a very conservative place to put money. And the reason this happened was because when Lehman Brothers defaulted, there was hundreds of millions of dollars that the fund kind of had to write off, and this led to a $400 billion outflow from money market funds. So if you think in a week, so if you think about like, hey, where's a safe place to put your money? It's a checking account, it's a savings account, and probably three is a money market account.
Mm-hmm.
AIG took a bailout of $150 billion. This was also on September 16th. So they were in trouble. And this is an insurer. So this wasn't an investment
Mm-hmm.
bank, but they got in trouble because they were overexposed to credit default swaps, CDSs, which was related to the subprime mortgage. The FDIC seizes Washington Mutual. This was September 25th of 2008. Wells Fargo acquires Wachovia. This was October of 2008. And then kind of the last part of this, October 2008, is that Congress approves the TARP, the Troubled Asset Relief
Oh
Program,
yeah.
and $700 billion to stabilize the financial system. So this happened in a very, very short period of time. I think arguments for something like decentralization probably goes back to when we moved to a fiat system and we kind of, our currency is no longer backed by
Yeah.
gold in a safe somewhere. But basically, the white paper, which was authored by either a person or a group that's an anonymous person, Satoshi Nakamoto, basically says like there has to be a better way. The way that we're doing things, where with currency that is tied to a central system
Yes.
that is at the whim of trying to get elected and things like that, is not a good system. So in the white paper, Bitcoin, it introduces new tech, Bit plus coin. So Bit has digital, references, coins obviously related to money, and
Mm-hmm.
peer to peer, which means that we cut out the middleman. There's no longer somebody that has to, verify. It's basically you deal directly with who you're working with. So the key components that were laid out in the white paper was this idea of centralization. So traditional electronic payments rely on financial institutions
Right.
to validate and process transactions. What Bitcoin does is say, hey, we're going to go decentralize and use a network of nodes or just computers that validate these transactions independently.
Mm-hmm.
One of the challenges with banks, Tim, is double spending. So, like, if I write you a check and then you deposit it in the system, a lot of things have to go right for that to not double count. Now we're in a place where we can do that, but it takes time, it takes
Yep.
money. So Bitcoin solves this by using a distributed ledger called the blockchain that's managed by all participants on that network. So it's multiple copies of this system. It uses something called a proof of work mechanism that these miners are trying to solve these equations to say, okay, what is true and authentic? The big things with this is it's transparent. One of the news stories that came out today is like someone that had bought Bitcoin very early in the days, just it stayed there like dormant for years, and they moved $150 billion off. I can see that, you can see that, but you can't see who it
The
is.
visibility, right.
But there's
Mm-hmm.
visibility, and it's immutable, right? Like you can't change it. Once it's in, it's in. We mentioned cryptography. The other big thing that I would say is the big part about this is fixed supply. So,
Mm-hmm.
in the government, like whenever we need money, we just print it. And that leads to things like inflation. And we kind of went through a period of quantitative easing. Bitcoin has a maximum supply of 21 million. I think 95% of those have already been like issued. So it kind of battles that, unlimited, that kind of loses the value over time because governments continue to spend and print.
Tim, it's interesting. I think the more I think about cryptocurrency, digital assets, Bitcoin, the more it really makes you look at money differently,
Mm-hmm.
right? I was talking to somebody recently of like, especially as we get towards more of a cashless system. If you or I pull out a dollar bill out of our wallet, if we have one, like it literally is a piece of paper that has value because we all say it has value and we agree
Yep.
it has value. And I think it's such an interesting position when you start to talk about things like, oh, yeah. Well, fixed supply, right? Makes sense when you talk about a fixed supply and the potential impact on something like inflation and a lot more economic principles behind this. But, we saw this recently at the pandemic. We all lived it firsthand, right? New dollars and enter the system. Therefore, at a very macroeconomic level, the purchasing power of the dollars that you hold on to are less if there's more of them that are in circulation. So I think when you get into some of these things like fixed supplies, you talked about the potential pro with transparency, obviously the updated technology. I think it's very interesting to people, especially when it's like, hey, the dollar is no longer tied to a fixed asset like gold. There's an opportunity for political influence. There's an opportunity for just new dollars to be inserted into the economy. We've seen that. We've lived it. We've experienced it. So these potential advantages make a whole lot of sense. Now, coming quickly behind that, I think are the reservations, right? Which would be, wow, the volatility, or the stories people hear of people like losing access to be able to get to their coins, that they have, and
Yeah.
ultimately not being able to get it, or hey, I don't have the backing of something like the FDIC, like I do on a traditional account
Right.
of 250 or whatever that number is, in terms
Yep.
of the reserve. So as you look at both the pros, and then let's talk about the other side of the equation, what are some of the objections or the risks, or the things that people are really thinking about, while all of those sound so good with the fixed supply, the transparency, the technology, and we'll come back and talk about some of the blockchain and so forth.
Yeah.
But I want to follow that up with the thoughts that I think creep quickly behind, which is like, that all sounds good, but dot dot dot.
Yeah, I think a lot of the objections are associated with risk, and we can kind of talk about risk separately. But I think early on, when I started hearing about it, I myself was like, oh, that sounds like a fad, or just that doesn't sound, it sounds weird, right? And I go back when I talk
Yeah.
about this, like in a presentation, um, you know, what I was taught, about in my certificate, the one of the things that caught my eye is that, the three most important developments in global commerce
Hmm.
before blockchain were fire, the wheel, the internet, and now number four is blockchain technology.
Yeah, not
Um,
fire as in financial independence retire, like fire.
no, like fire, yeah, like rub sticks together, that type of
Right.
thing. Um,
Yeah.
and I was thinking about like the internet, and when that came out, I think there was a lot of the same type of sentiments, Tim, where it was like, what, like, is this a fad? Like, what is this? And there's I don't know if it's Good Morning America, but it's Bryant Gumbel, I believe, and Katie Couric, and they had someone on, and they're like, one of the questions I think Katie Couric asked is like, what is internet anyway? Right? And that was like, I think that was in the early 90s,
Yeah.
right? So that wasn't that long ago. So I think blockchain is kind of the same thing, and I think we're kind of past the fad stage, right?
Feels
So
like
if
it.
you look at like annual transaction volume, and these are not going to be the most up to date, but like Bitcoin, 1.3 trillion. If you look at something like PayPal, zero point 0.6 trillion. Discover Card, 0.2
Wow.
trillion. Bitcoin, and you could probably put a lot more companies in here now because of the, Bitcoin is up 20 some odd $1,000 in the last month, or whatever it is.
Mhm.
Um, but Bitcoin's market cap is bigger than, it's up 31,000 month over month, but Bitcoin's market cap is bigger than JP Morgan, Disney, United Healthcare, PayPal, MasterCard, Home Depot. Coinbase, which is one of the major broker,
Mhm.
has more account holders than Schwab, E-Trade, and Interactive Brokers
That's
combined.
wild. Yeah.
And I think the other thing too is, like, if you're like this is like a fad, like, all the major university endowments are invested in Bitcoin.
Yeah.
Harvard, Yale, MIT, Stanford, Dartmouth, UNC, they're all in it. A lot of pensions are now. Now it does raise questions of, like, especially if pensions are there, like, are we exposing our retirement system to too much risk? But I would say more than half of the top 50 universities offer courses on digital assets and blockchain technology. Blockchain engineers are the fastest growing engineer type, and they're I think one of the highest paid as well.
Mhm.
So this idea of like this is kind of not mainstream is false. Um, I think a lot of people think of it like, especially early on, like you buy blockchain. Like I read a book about the Silk Road, right? So that was a online marketplace for illegal drug activity. So if I wanted to buy
Hmm.
a drug, I could get it online. A lot of that was used. A lot of those sales were used in digital assets because of, yeah, it's hard to trace. Um, so it can be used for nefarious purposes. I think something like 1% of Bitcoin is used for fraudulent activities, but compare that to cash, it's 2%.
That's right. Right.
Um,
Relative. Yeah.
and fraud has been, with any type of investment, fraud has been at the very first, like, US investment. So the first bond issued by Alexander Hamilton when he was setting up the treasury, there was an insider trading, like, scam with that. So, you know, Bitcoin is not unique in that. I think there's a lot of people that they object because there's just too much to buy. There's a coin for everything. And I do think that, like, a lot of these digital assets will go through like a .com, like that
Hmm.
we had, where, if you had .com behind your name, you're going to IPO and making millions. And I think eventually, like, there'll be a contraction of coins. I think that probably one of the big things that we talked about a little bit is that critics argue that there's no legit source of value. So they argue that, you know, critics often say they define intrinsic value in terms of, like, physical commodities like gold, or income generating assets like stocks or bonds. Those are backed by the government or backed by a company that has earnings. But proponents, I think, pro digital assets would argue that the value is subjected and rooted in, like, the utility and scarcity of the digital asset, to fulfill a specific purpose. So if you look at Bitcoin, its value lies in the fact that it can act as a store of value, kind of like digital gold, a medium of exchange. It's like, so you can use this to buy things, and it's a hedge against inflation and government control. If you look at, like, the U.S. dollar, it used to be backed by the gold standard, as we mentioned, but once it moved to a fiat currency, it derives value from the trust in the issue in
Right.
government, right?
Yeah.
Whereas Bitcoin, derives value for, like, the trust in, like, the decentralized system. And then kind of wide, the US dollar gets value from it's a widespread acceptance as legal tender in the United States, but even across the world. Like, dollars are valuable anywhere, or in most places. Whereas, Bitcoin, its acceptance is by its users and people that believe that this is the future. So some of
Tim,
these other
I want to
things,
make
yeah,
sure I just want to make sure I understand that quickly, kind of the point you're making here. So some of the critics would say like, hey, cash backed by the treasury, stocks backed by the value of a company,
yeah,
right? Bonds backed
earnings,
by the government, yeah,
yeah.
earnings and the value of the company. Real estate backed by the structure, right? The property, what you actually have. Bitcoin perhaps doesn't have that same type of backing. It's trust in the system, trust in the users. Is that the point that critics would make there?
Yeah, that's right. That's right. And again, like, we're kind of crossing lines here because, like, I wouldn't say that Bitcoin is currency. You can use it as currency,
Mm, mm-hmm.
but Bitcoin is more of an investment. I do think that other types of digital assets, perhaps Ethereum, could be more, or even just like, I in the future, we're not going to have paper currency. It's all going to be, I think of, like, Star Wars. When you watch Star Wars, you think about, like, credits. It's
Mm-hmm.
all going to be digital. And I think that's one of the types of digital assets that'll take hold, is that those that'll be basically issued by governments. But then I also think you're going to have currency outside of that again are decentralized, that are, on the blockchain, that type of thing. So
Yeah.
so yes, that is what I'm saying, is that, it's kind of derived. It's kind of, we the people put value into this asset class, but it's people with a capital P, meaning, like, not just the United States, the world. So, but some of the other things, it's like, we can kind of get into the volatility and the riskiness. Some people are like, hey, is it too late to buy because it's spiking? I don't think there's
Yeah.
any, the best time to buy is, like, when it started. Or, like, I'm going to wait for the price to fall, or, there's too much hacker risk. That was one of the things I hear often, is like, what if this is hacked? And
Mm-hmm.
they did a study that said it would cost something like 10 to 12 billion dollars just for the mining hardware and infrastructure, and then operational costs of about $7 to $10 million per day to make a sustained attack where you essentially take control of 51% of like the nodes. It's
Mhm.
just it makes it prohibitive. So again, it's easy to say, hey, I'm gonna attack Bank of America's servers or something like this because it's located in New York. Um, but this is like worldwide, right? So it's almost like trying to, attack a castle that is on 7 continents.
Yeah, it
Yeah.
transcends any country's currency, right? We're talking about something that
Yep.
goes beyond that. So one of the things, and certainly I'm not an economist, you're not an economist, but we talked about too big to fail in terms of the list you went through back in 2008, right? These were entities that were too big to fail that had to be rescued, or at least that was the thought, right? Had to be rescued, or else our economy was going to crumble. I think you have to ask the same question here, right? For people that are like, hey, is there a future state where Bitcoin is going to be non-existent? The market cap it's holding is getting to a place where as you gave some of the numbers, you've got to ask a question like, does it become too big to fail, right? Even if there's holes and challenges in the system, and I'm not saying run where everyone else is running. That may not be the best play for you, but you have to at least acknowledge and respect what is the actual uptake and the amount of dollars that are flowing through digital assets, and specifically here we're talking about Bitcoin.
Yeah, I think it warrants, it warrants attention and like we said at the start of the episode, like the research to say like, is this something that I want to do myself,
Yeah.
right? And um, yeah, and often a question I'll get when I talk to people about this is, again, and I'm not saying to like sell your house and liquidate your
Right.
portfolio and put it all into Bitcoin. I'm not. I think it's, again, if this is something that's right for you, it's part of a balanced portfolio.
Mm-hmm. Mm-hmm.
Um, so I had another point, Tim, but I lost my train of thought. But I think I do think it's worthy of. I think it's worthy of an asset class similar to like large cap, small cap,
Mm-hmm.
international, emerging market, that type of thing. And I know we'll probably talk about it in what it looks like in a portfolio, or how this looks like in an investment.
Tim, what are some of the other objections that you're hearing, right? We talked through some of the risks in terms of, obviously the fraudulent activity, the concerns that might be there, the volatility, not being backed by something like the FDIC. What are the other objections that you hear and typically encounter as you're engaging with prospective clients or even our team of financial planners when we're having these conversations about where does this or doesn't fit in the strategy?
Yeah, I think the biggest one off the rip is like the volatility.
Mm,
So, digital assets are highly volatile and can experience dramatic, price swings in short periods. I think the counter to that, so like if I were to ask you, Tim, like over the last 3 years, like if you owned a portfolio that was 100% in Bitcoin or 100% in like Tesla stock, what do you think would be more volatile?
more volatile? I mean,
Yeah.
I would think it would be Bitcoin, but I feel like you're leading me down a different
Yeah,
path.
it's actually Tesla.
Yeah.
Tesla, um,
Interesting.
if you go out 5 years and it's even like a wider gap, between Bitcoin and, so I'm looking at, kind of the x-axis being volatility or standard deviation if you're nerding
Yep.
out from an investment perspective, and like the y-axis being like the return. If you look 5 years out, the return on Bitcoin is 64.7% with a volatility of 68.3%. If you compare that to
Mm,
Tesla, it's 70.8% with a volatility of 76.5%. So a little bit more return for a little bit more risk. Because I was, one of the things is like if you look at the top, like in the S&P 500, um, you have Nvidia,
mhm.
Tesla, and a few other companies that are as volatile, if not more volatile, depending on the time, what you're looking at. So what I would say is like, yes, it is volatile. Now, again, we are proponents of not buying an individual stock. You want to
Yep.
buy, the S&P 500, and that all those eggs in the basket, kind of, make a little bit of a smoother ride. But it's not accurate to say that like some of these tech stocks that are in the S&P 500 are way safer than, something like Bitcoin. Um, so that's a big thing, and I think that's interesting to examine. I think another big thing, and again with the presidential election, is the regulatory concerns. So
Yeah.
regulations around digital assets can vary from by country, and are evolving. I would say the United States has, and I think what digital assets are, they want more. Like sometimes there's news that like the SEC like makes a rule in, and we think it's bad for the digital assets. I think digital assets, they just want a rule in, and the SEC and some of these other entities have been unwilling to kind of draw a line in the sand.
Hmm.
Um,
Hmm.
so the regulatory concern is important. Security risk we talked about.
Hmm.
Is it is the blockchain, is the ledger like susceptible to hacking or fraud or phishing attacks? I think probably the big thing is, you've heard people losing the keys to their wallet and like you can't get them
Right.
back, right? So, or if they're all, if your coins are stored on a hot wallet, which is kind of connected to the internet, they're more susceptible to risk and fraud. We've heard about FTX and all
Mhm.
that, and some others before. Versus if you store it on a cold wallet, which is kind of away from the internet. Other risks are lack of liquidity, custodial risks, like we mentioned with
Yeah.
FTX, environmental concerns. I know Bill Gates, I think, is a big one on this with, the amount of energy it takes to mine and things like that. And I think that's not just unique to Bitcoin. That's just,
Hmm.
I just read a book called Chip Wars, which is about, kind of the race. This is like the next oil with silicon chips and things like that.
Yeah.
So those would be a few I would name.
Tim, let's talk about the role that digital assets may play when it comes to portfolio diversification. So you mentioned in the last episode that you went through the certified blockchain and digital assets program, and I'm curious, as you went through that and you thought about it in your own investing plan as well, what is some of the thoughts around where digital assets may fit in terms of portfolio diversification? Obviously, not investing advice, but my mind's spinning. Is this a big percentage of our portfolio? Is this a smaller percentage of our portfolio? How are you thinking about this?
Yeah, I think when I was learning about Bitcoin in particular, I think, and again, not investment advice, but they were kind of making the case of like, if you were going to invest, like even something like a 1% allocation strategy to something like Bitcoin
Hmm.
is worth it. And so if we think about the like principles of investing, one of the big thing with investing is diversification. So the reason that you want to diversify is due to something called correlation. So correlation is like, how do these investments act when the market
Hmm.
changes? So like when interest rates go up, does the asset class go up? Does it goes down? Like how does it act, between them? And one of the criticisms of like a traditional investment strategy is that they kind of all act very similar. Stocks typically act a little bit differently than bonds, but inside of stocks, if you have large, mid, small, international, emerging market, they kind of all act the same. So some people would put things like commodities or real estate or other things to kind of be uncorrelated with those
Mm.
major asset classes.
Hmm.
Classes. So the big thing that Bitcoin offers or digital assets offers is an uncorrelated, a very low correlation between digital assets and a typical traditional asset class. Um, we really haven't had a new asset class since the 1850s, Tim. So I think oil, when they come out, when they securitize oil and you could trade oil, that was really the last time. So if you believe in diversification, something like a digital asset in your traditional portfolio or just in your portfolio in general, um, is something to look at. So, and to go back to the 1% asset allocation strategy, basically what it was saying, and again, this kind of sounds, it you're trying to have some upside by limiting your downside. So if you look at a typical portfolio of 60% in stocks, 40% in bonds, this is considered a balanced portfolio. You know, if in year one that portfolio earns 7% and then cumulative 14.5%, that's kind of a good basis to then measure, what happens if I inject like a 1%
Right.
strategy or 1% Bitcoin. So
Yep.
what we label this second scenario is called, the digital asset portfolio with a wave and a crash. So if we go back to 2017, Bitcoin rose by 1,500% in 2017 and then fell by 84% in 2018. So this is the wave with the crash. If you were to put 1%, so you would take out 1% from the 60% of your stocks. So you have a 59% in stocks, 40% in bonds, and then 1% in Bitcoin. That first year is not 7%. With the wave, it's a 22% return on investment. Now with the crash in that second year, so it goes down, the 1% holding that you have in Bitcoin then crashes to 84%. It's not the 14.5% if you didn't have Bitcoin, it's 15.4%
Mm,
with the crash. If you go to a total loss, so this is like, it completely loses all its value. It's 6% in that first year, and then when it loses all its value in the second year, it goes to 13.4%. So again, I know this is hard from verbally to explain this, but if you look at a typical portfolio, year one of 7, year two of 14.5, and you compare that to the wave and a crash of year one at 22 and year two at 15.4, what we're saying is that a little exposure to Bitcoin could give you a little bit more upside with not a whole lot of downside. And again, not investment advice because that sounds kind of like snake oil salesman. So I want you obviously to verify the study and what that looks like. But I think what the kind of the modeling shows is that you don't need a huge allocation or exposure in Bitcoin for it to help you diversify, but also give you, some of the upside, with very little downside.
And I think what's really helpful in that example, right? Nothing more than that being an example is that it helps us understand when we're doing modeling of scenarios, like let's objectively talk about what actually may happen or may not happen, right? I think we see the swings and if we're just tracking, Bitcoin's value out of curiosity, we're like, whoa, right? But we're thinking about it in terms of almost like a totality of a portfolio. When you get to a very small piece of the pie, as you mentioned, what we're trying to find is are there situations where we can have some upside that outweighs the potential downside, right? Or
Correct.
minimizes, the downside, and are we willing to take that risk? So, Tim, I think this is a good spot for us to talk about the difference between investing in something like Bitcoin itself versus, earlier this year in January 2024. I actually think we were flying home from a speaking event when the news came out that the SEC approved the first Bitcoin spot ETF in the United States, which was big news for obvious reasons. So a lot of people listening might be wondering, like, what's the difference if I'm actually buying Bitcoin versus I'm investing in something like a Bitcoin spot ETF? Can you explain that further?
Yeah. So when you buy direct, it's kind of like real estate. Like when you buy directly, like there is benefits and risk associated with that. So, um, like if you buy digital assets, say on Coinbase, and which is a marketplace where you can buy, you hold those digital assets directly. So
Mm-hmm.
so you are, if it's Coinbase in particular, you're putting trust in the Coinbase that they're doing all of the security and regulatory things correctly, so that they are securing your coins or tokens, whatever they are. Um, and you're not getting hacked, right? So you own those coins directly. You have keys associated with that wallet. Whereas a spot Bitcoin ETF, you have an institution that owns, a pool of Bitcoin or a pool of Ethereum, because also released the Ethereum spot ETFs as well. So you're trusting something like a Bitwise or Fidelity or someone to say, hey,
Mm-hmm.
buy it for me, and then I'll buy shares of that. So it's representative of that coin. So when you're buying shares, like you don't own it directly, but you own a share of like what the value of those pooled coins are, or, whatever the asset is. So if you're weary of doing it directly or losing your keys, it's kind of the same thing we talk about with real estate. Like some people are really jacked up to own real estate directly, and you get tax breaks and benefits and all that kind of stuff, but there's also headaches and risks associated with dealing with tenants and all that kind of stuff, and dealing with permanent and just just different things associated with it's true with Bitcoin, right? So you can kind of say, hey, I'm going to trust this institution to do it, or I'm going to buy it directly, and I'm okay with that. So up to this point, most people had to go through and buy it directly, either on a Robinhood account or somewhere else, PayPal, Coinbase, because that's all there was. And then this year, the most successful ETF launch, and there's been thousands of ETFs, were the spot Bitcoin ETFs. I think the second most was the Ethereum one. So a lot of people are saying, hey, I'd rather just put this in a traditional portfolio with my IRA, with my brokerage account, buy a percentage of my portfolio that way. And that's a good way to do it as well.
I love the real estate comparison, right? It's a good one. We talked about that so many times on the show. For some people, it's let me get my hands dirty. I want to do the buy, the fix, the flip, the hold, the property management. Other people are like, not for me, but I like the exposure idea, and I think that's the same thing here. There are people that geek out about like the cold wallets, and they're checking it every day, and then there's other people. Admittedly, I'm one of them where it's like, I don't want to deal with it. Like,
Yeah, and one of the things, because they trade on market, like these ETFs, like if something happens in the middle of the night, because the price, like unlike the stock market, people like go home and go to
good
bed, and
point.
like we're not trading.
Good point.
The
Yep.
the the blockchain is 24/7, 365. So like if something happens on Thanksgiving and I want to buy or sell, I have to wait for the markets to open. Whereas if I own it directly, I don't have to wait. Right. So
Mm-hmm.
that's one of the things outside of like the risk. And, again, like to each his own. Like I think there'll be, I do think, if you talk about the evolution, like you know how spot Bitcoin and spot Ethereum, I think you'll eventually get sleeves of these investments where you'll have like a 60-40 Bitcoin to Ethereum. You're going to have
Mm-hmm.
other digital assets that come on board. I think you will start seeing them more in 401ks in the future and things like
Yeah.
that. Like that's going to be a thing. So it'll be interesting to see where it goes.
And Tim, correct me if I'm wrong, but it's important here, I think, to know, just like we talk about with the tax considerations of other investments, if I go through something like Coinbase and buy Bitcoin, right, directly, and I hold it, whether that's a hot wallet, cold wallet, I'm using after tax dollars to buy that Bitcoin. And then we have to think of, we'll talk about the capital gains and all that here in a moment. If I have a spot ETF exposure inside of my IRA, for example, right, these aren't one and the same when we think about
Correct.
how we're, okay.
Yeah, it follows, and it goes, to kind of get into the taxation. Like digital assets are taxed as property, so the IRS looks at it as property. So, and that's kind of one of the rubs here is like when Bitcoin was kind of introduced, it was supposed to like replace the dollar, or that was the idea. And again, I do think that a digital asset will replace the dollar. It's just not going to. It won't be Bitcoin.
Mm-hmm.
So one of the things that was problematic for people that were like, hey, I'm going to go and, spend $5 on coffee at Starbucks using Bitcoin. That's a taxable event. So anytime
Mm-hmm.
that you sell or trade digital assets, you bought something with digital assets. So like back in the day, I'm not sure what year this was, but one of the first transactions on the blockchain was someone bought pizza
I remember
for
this. Mm-hmm.
$10,000, 10,000 Bitcoin. Sorry, so they bought pizza for 10,000 Bitcoin. For at the time, 10,000 Bitcoin was worth like $41. Now, if you use 99,500, that same 10,000 Bitcoin would be worth $995 million. But regardless, that's a taxable event. If you receive digital assets as a reward. So like one of the things you can do is you can stake your digital assets. So you can't do this with Bitcoin, but you can do this with Ethereum, Solana, a few others. But you can stake them and think of that as kind of a way to um, earn interest on your Bitcoin, or on not on your Bitcoin,
Mm-hmm.
on your digital assets. So like those stake and rewards, or a lot of these companies, a lot of these digital assets will offer to like new users, hey, like if you go through this and learn about they do this on the Coinbase platform, we'll give you, 10 coins of our coin.
Whatever
Those are
coin, yeah.
all reportable and taxable events. And then if you convert, like you can convert um you can convert Bitcoin to Ethereum, or Ethereum to USDC or something like that. That can also be a taxable event. So many platforms will provide, Tim, a 1099 to describe the transactions, but these can be like a tree, especially if you're you're doing a lot. I believe in 2026 the IRS is going to require digital asset brokers will be required to issue Form 1099-DA, which will report digital asset transactions to the IRS, similar to how stock transactions are
Mm-hmm.
reported. So right now, if you need to do that, you have to go and pay like a service to help you plug into like whatever platform you're on and do that. I think in the future, from what I understand from the IRS ruling, is that they're going to require these platforms to report that. Um, so if you have a brokerage account and you do like a lot of buy in, sell in, like you might have pages and pages
Yeah.
that you have to submit that shows capital gains and things like that. And it's going to be the same thing with digital assets. And it is really important. It's one of the first questions the IRS asks you on your tax return is like, have you bought, sold, traded digital assets? And if yes, click here, and then they want to see support and documentation.
This, I think, is an interesting part as we think about the widespread adoption, right, of this. We were clear earlier about the definition of a currency. But when we think about the potential of the widespread use of this from a transaction standpoint, the idea of those being taxable events and taxable events that are reported, like, and you mentioned the pages, whether that's from transactions that are incurred, or especially about the apps that are out there, how easy it is to interact with some of those things where you take a 2-minute learning thing and they pay you, 10 whatever random coin, like that becomes fairly cumbersome from a tax filing standpoint.
It does. It does. And I think the IRS is trying to catch up as best they can, because I think they know that for a while this has kind of gone by the wayside. And I think that's why they kind of bumped it to the top of the list, because there's just a lot of money, as we see in some of these values of these coins
Mm-hmm.
ebb and flow. And there's just probably there's a lot of taxable things that are not being reported that they're
Yeah.
trying to like get their arms around. So yeah, I mean, again, like when we haven't even talked about things like use cases, which, like one of the, there's a lot of things that digital assets can solve, but like if you're in countries where like inflation, you have hyperinflation, where the price of bread is double or triple in the morning than it is in the
Right.
afternoon. Something like a stable currency is like really attractive to you. So there are economies that are already using digital assets. My wife's Brazilian, so like anytime that you have to like send money back and forth between country, there's just it's a lot of time and a ton of money,
Yeah. The cross
and
border
cross
is a
border
pain.
and all of
Mm-hmm.
this, and like what they take as a percentage. Um, like there's a lot of use cases that we haven't really talked about. We're really
Yeah.
looking at it from like, potentially the exchange of goods, but more as like a store of value, like an investment. It just This type of technology really
Mm-hmm.
spiders away. And then again, part of that is like, how do we treat the taxes of this? And I think it'll continue to evolve, because again, eventually there will be, in my opinion, a coin or some type of asset that will make the dollar maybe not obsolete, but I think eventually we'll get to that point where we're not, I don't typically carry cash. I use my debit, but I think the next thing is going to be something like a coin,
Mm-hmm.
that type of thing.
Speaking of use cases, let's go back to the pizza scenario. I was just looking that up for the details. I remember hearing that story. So here it is. On May 22nd, 2010, a man in Florida paid 10,000 Bitcoin for pizza. He bought 2 pizzas from Papa John's that day. It was considered to be the first ever purchase with Bitcoin. That's wild, right? And I think he's come out publicly, actually. I think we know who this guy is, and he's had some
Yeah.
interviews and things as
But
well.
can
So
you imagine that $995 million
for
for
Papa John's
pizza? Yeah.
pizzas. I just
Yeah.
saw the commercial last night for like 2 pizzas, 6.99 each, like
Yep.
that
Yeah, and I
hurts.
think I think when I learned about this, like I was like, oh man, that's like a $500 million pizza. So you can see just in the short amount of time
Yeah.
again where that's gone, and yeah, it's interesting.
Why, Tim, why is the SEC's acknowledgement, the IRS's recognition coming out with rules, why are these important when we think about the adoption of these going forward?
I think I think it's kind of like this unknown, like when you're operating with unknowns, there's just like a lot of risks
Mm,
associated. So I think like what the community wants is for the government just to like draw a line in the sand, whatever that is. Again, they want it
tell
to
us what's
be,
okay. Yeah.
yeah. And I think without that, in the absence of that, with that uncertainty, it creates more risk. So I think that's the big thing. And again, when you look at the campaigns, I think the Trump campaign was more forthright. Like he attended a crypto conference this year and spoke
Hmm.
and was doing Trump things about the current leadership and how it's bad for crypto and that type of thing. But um, so like that, the market reaction is really kind of, I think Trump has said that he is going to be more friendly, and I think what the establishment is worried about is something like Bitcoin or something similar going to take the function of issuing currency away from governments, right? And does like the government become almost less important because it's
Hmm.
not, it's the US dollar is now, subordinate to something else. Like that's a real concern. But then also like, I know, reading this book, Silk Road, which kind of talks about that drug, like it is true to say that it's easier to do nefarious things with something like a digital asset that's harder to trace and track than other things, So I think, again, I think it's just one of those things that, it's, I do think that's an inevitability, right? I think it's an
Hmm.
inevitability. I think the government has to figure out how to kind of get on the right side of this and like what makes sense in terms of regulation, and where does I do think that, the if we talk about these types of coins that are, um they're called central bank digital currencies, CBDCs. These are digital currencies issued by central banks.
Hmm.
So it
Hmm.
doesn't have the DeFi or the decentralization effect, but it's basically a digital form of nation's currency. I think there are many governments out there that are working on this, that are going to have these, and I think that'll be the first step into then.
Yeah.
Okay, what does this look like? Um, and it could be where you have one that is, hey, it's kind of issued by the government, but then there's one that where the supply is fixed, like in the case of Bitcoin, and
Hmm.
you can use different type of currency to pay for things and that type of thing. So um yeah, I think it's fear. It's like, I think it's like a fear of the unknown
Yeah.
on the government side of like, how do we handle this? What does this look like? Is this currency? Is this property? And I think those are still kind of to be
Hmm.
worked out, but it's trending, even before the election, is kind of trending positively for digital assets. But I think with this administration, again, all the other politics aside, depending on what you believe, this will be good for for digital assets.
Tim, the last question I want to ask you is around some of the fees. We often talk about fee efficient investing on this show. How do we obviously maximize our returns, keep our fees as low as possible? It's a big focus of what we do on the planning side with our financial planning team. So here, when we're thinking about the current state of fees and perhaps the future, what will look different, and whether someone's directly buying coin or they're buying a spot ETF and a brokerage account or retirement account, how are you thinking about the fees on these transactions right now, the expense ratios that are involved, and what impact those do or don't have as we look at the makeup of this having a role in the portfolio?
Yeah. So if we talk about buying directly, so like if you were to go on to Coinbase or PayPal or some of these other platforms and buy Bitcoin, what you typically are paying, Tim, is a transaction fee to these platforms. And then there's typically a spread. So like if Bitcoin
Hmm.
is selling at um, 99,500 dollars, like I actually might buy it for more than that because they're gonna charge me a transaction fee and then they're gonna charge me a spread. One of the ways that I probably should have said this up front. Like I do invest directly. I use Coinbase, not a a plug for them. And then I buy the spot Bitcoin ETFs. One of the hacks that I did that they are discontinuing this month, I think in next couple of days, is that part of my paycheck from YFP, I would pay myself in Bitcoin, which would basically you would still pay the spread, but I wouldn't pay that transaction fee if it was deposited
Oh, it's
right
going
into my.
away.
It's going away. Yeah. Now they're supposedly
uh
coming out with something else. So my dollar cost averaging strategy of just buying a little bit at a time is going away for the time being, and there might be
mm,
something else, but that was kind of a way to kind of get around some of the fees, which are fairly prohibitive. Like if you buy $100 worth of Bitcoin or whatever, you're going to pay $4 or $5. So if you look at that as a percentage, that's a good chunk.
hmm
um the so that's one way, one area to look at. If you look at it on the spot Bitcoin ETFs, they are going to be more expensive than So if we look at expense ratio, so the expense ratio is what the and fund manager take to kind of manage that fund. So you see this in any type of mutual fund or exchange traded fund ETF. So that fund manager, they have to pay for their salaries, office space, data, analysts, all that stuff. That costs money. So what they do is they charge an expense ratio that takes a percentage of the funds to fund all that. And those can range widely, right? So we always believe is like keep the expense as low as possible. So our average, I think, expense ratio for our portfolio is something like 5 basis points,
hmm
0.05%. So on $100,000 portfolio, it's like $50 a year. We've seen clients come in that have north of 1%, 1.5%. So that's 1,000 or 1,500 bucks per year. And again, it's not a line item anywhere. It's just kind of absorbed in the fee. You don't see it come out except for it says, hey, you're paying this expense ratio, this percentage. So a lot of the spot Bitcoin ETFs, Tim, are kind of on this introductory like 0%,
Yep.
until a certain amount of time or a certain amount of assets come in. But a lot of the ones are kind of like 20 basis points, 25 basis points, something like that. So it is a
hmm
little bit more expensive. But if you kind of line up the two, they're I would say like probably like doing it directly is even more expensive unless there's another solution that I don't know about. But I still think worth, if you're putting in a percentage in your
hmm
portfolio of a spot Bitcoin ETF or a spot Ethereum ETF, I think it's worth to pay that to get that diversification play, the upside with hopefully not a ton of downside as the market continues to mature. So that's kind of some of the costs associated. So typically, like when you buy, like if you compare buying a stock directly, you don't have an expense. So if I buy Tesla stock,
Right.
sometimes I have to pay like a transaction, like a ticket charge to buy that stock, but I don't have an expense ratio, but I don't get the diversification of like a pool
hmm
of stocks and bonds. Whereas for if you're buying Coinbase, you have to buy a ticket and then you're typically paying a spread of like
hmm
what is the actual price to what Coinbase or PayPal is going to charge you. So it's just kind of being aware of that. So it's not without cost on both sides. So just understanding what those are is important.
Just like we talk about with fees elsewhere in the portfolio, factoring that in as we're looking at, the assumptions around performance over the long term, and those matter, right? We've talked about this many times on the show, but if you have an expense ratio north of 1% versus 5 basis points, that's a big deal,
Sure.
over a long period of time. And here we're talking about maybe some higher expense ratios, but are we willing to, deal with that as we look at some of the upside and having, another asset class, as you talked about throughout the episode, and adding some of that diversification. So those are the decisions, right, that we're trying to make, and certainly relates to everyone's plan individually. So, Tim, great stuff. We've covered a lot of ground. And if you're listening, wondering, hey, how do digital assets fit into my investment strategy, my retirement plan? We'd love to have the opportunity to talk further with you about our one-on-one fee-only financial planning services. Certainly, investing in retirement planning, an important part of the plan, but just one, many other parts that are included in that service. So you can head on over to yourfinancialpharmacist.com. You'll see a button to book a discovery call. That will take you to a calendar where you have opportunity to talk with Tim. We'll learn more about your situation. You learn more about our services. Ultimately, we'll try to determine what the best fit is going forward. So, Tim, thank you so much for taking the time. This was a lot of fun, and we'll be back here after the holiday.